Hello and welcome to a brand new show of Market Makers. Our guest on the show today is Tarun Kataria, Chief Executive Officer of Religare Capital Markets. Tarun, what a delight to have you back on the show. Thank you for joining us.
Good to be back. Thank you.
Let's talk about the market environment. Indian markets are up 20%. Looks like we are ignoring all the bad news.
I think there's a strong sense that sort of the reform agenda will come through, and I think that's driving the market like it did some months ago. There's a sense that interest rates will get cut first quarter calendar next year, which was exactly the scenario this time last year. So you're seeing the buoyancy in the markets, really on the back of sort of reform, at least the mood around reforms. Whether the reforms really translate into anything remains to be seen, but the messaging is right. You can see what's happening politically in Delhi. People are, at least the UPA government's pushing as hard as they can. 50 to 100 bip rate cuts are starting to be priced in, creating a good environment for the markets. And I think the other thing that people are sensing is that globally, from a macro perspective, we're probably at the bottom. Because even if you look at the China PMI data starting to say, okay, maybe the worst is over. So there's a lot of sort of good stuff happening globally and clearly driving our markets higher.
I like your analysis, but I think you're painting a too rosy picture. What if crude prices go haywire? What happens if something in Europe backfires? What happens if the fiscal cliff actually kicks in?
Well, you see, the event risk is always something to be mindful of. Personally, I think if you look at what they're saying out of the US, they'll probably sort the fiscal cliff out. If you look at this morning's press, sort of pre-Christmas, it's too intense a issue to deal with if it actually comes to pass. And if sort of the Republicans say, okay, there's some room to raise taxes, which I think is the right thing to do, and then the Democrats say, okay, we cut expenses and look at entitlements, which I think is the real sticky point, because if you look at the US budget, almost 70% of revenues go to entitlements, yes. Social Security, Medicare, Medicaid, and nobody's ever wanted to touch that because politically it's very, very sensitive. So there's a sense that there will be give on both sides. If there's give on both sides, cliff gets taken care of. Europe, I think, is long-term structural. And again, the noise coming out of Europe is, okay, Greece, we'll give Greece a little bit more time to sort itself out. I think longish term, France remains something to be very mindful of because it's frankly like India going down a socialist path. And we all know socialism doesn't necessarily do much for people's GDP. It's great to talk about, but does nothing for GDP. So that's a concern.
True capitalist speaking.
It's not true. I mean, you've got to find the balance, but you can't go so far left as we saw in our own country in the 60s and 70s. It did nothing for GDP growth. So we need to be mindful of that. So I don't think there's anything major event risk that can come out of Europe. Fiscal, as I say, will get sorted. Europe, everybody's pretty much priced in everything else. The overhang 6 or 8 months ago was China. Hard landing, soft landing. I think that's now gone away. And the sense clearly is China's bottomed. Service PMI was 50.
Tarun, a very basic plank on which Indian markets have rallied this year is global liquidity.
Yep.
If you are making a case that the global growth is making a comeback, the repercussions could be that central banks, they could take it easy, and that could challenge global liquidity, which indirectly would impact us.
I think that's a long ways away. I don't think, whatever you might do, even if the US comes back, it's going to come back in a very muted sense. Because I think one of the things that we don't really talk about enough is the demographics of the US, like the demographics of Europe, almost suggest that you can't go back to 3 or 4% GDP growth because the baby boomers have passed. The productive population of most of the westernized economies is declining. So you cannot go back to the growth rates that we saw over the last 20 years because the productive population just doesn't exist. So if you get to a run rate of about 1% GDP in the US, I can't see it getting much beyond that. And that suggests that you cannot aggressively raise rates to spoil the whole global liquidity story. So I would suggest the global liquidity story continues. Maybe in a couple of years, people start talking about, long bonds sort of going from, I guess, 160 or 165, whatever it is, to 3%, just to throw a number out. But plenty of time for that.
Now, what has differentiated Indian markets from rest of the world is the entire consumer story. So what's the best way to bet on Indian consumer?
I think there are three ways to play it. Obviously, there's a discretionary way to play it, which we think right now is something to be thinking about. Financial services is a way to play it. There are a number of sort of NBFCs that sort of service that sector. Banks generally, I think, are a great way to play it. And obviously the FMCG space, which expensive at the moment, but still a long term, there'll be many more consumers coming out into the spending sort of story. Those would be the ways to play it. Real estate, obviously something to think about from time to time. Is
it too early to take a dive in deeps, in beaten down cyclicals?
I think it's a bit early. We've seen some of these names sort of rally, but are you going to see 50, 60, 70 or doubling in a couple of years? It's probably still a little bit too early in my view.
Broadly, if I map the percentage change this year, Indian markets are up 20%. Do you expect a double-digit gain for next year as well?
See, if you believe global GDP or global macro is at its flow and starts to pick up, if you believe liquidity continues to be as I do, if you really believe that India slows down sufficiently and CPI comes off, WPI comes off, and the Fed or the RBI is able to cut rates by, I'm getting aggressive here, but let's just say 200 basis points. That sets the basis for, can we go to 23, 24 on the Sensex by the end of next calendar? Sure, you can. Absolutely can.
The consensus on the street is that Reserve Bank of India come Jan 2013 will cut rates and that will kickstart a new bull market. Isn't that too naive?
I think that's my personal view. I think that's a bit optimistic.
That's a consensus view.
It is a consensus view, which is what happens. So consensus drives the market, as we've seen driving the market higher. But when they actually figure out, or when we all figure out that actually 50 or 100 basis point cut is not moving the needle, you need 300 or 400 basis point cuts in rates, which cannot happen given where we are with our inflationary numbers. The market will sort of pull back a little bit, probably for a short period of time. So I'm not of the view that there's going to be, material cuts in rate that drives markets massively higher from here. Inflation is structural. That's the problem. And it's been there despite growth having come up from close to 10% to what this year, this fiscal, if we above 5% would be a good outcome. So I don't see massive cuts by the RBI.
What drives the market are three factors. Number one is sentiment, which has improved. At least global sentiment towards India has improved.
Yeah.
Second is liquidity. We made a case that there is a lot of global liquidity sloshing around and hopefully India will get more liquidity going forward. The third important trigger is earnings, which is the most difficult one to predict.
Correct.
What are your thoughts there?
Well, I think that's a tough one. Are we going to see a massive material pickup in earnings just yet? I don't think so. We were also to think commodity prices come off, rupee goes to 52, 53, all that sort of it's on its head, and GDP growth will remain muted. So I don't see a material change in earnings, and therefore you sort of got to question whether companies trading at 30, 35 times while are perfectly good companies, whether it's time to sort of take a little bit of money off the table. So are you going to see material changes in earnings from here over the next 12, 18 months? Probably not. But are we at the low point? Yeah, we're pretty close.
This time around, if I look at brokerage recommendations, for the first time we've got more upgrades than downgrades. Do you think earnings, if not in Q2, maybe in Q3 will bottom out for sure?
As I say, we're 1 or 2 quarters from the bottom. But it's a parallel to the US GDP story. Are you going to see a huge jump up from here? The answer is no, because the rupee is going to continue to remain under pressure. Growth will be subdued. Commodity prices, if China starts to recover, and there's every reason to suggest that the recovery of China is underway, that will put upward pressure on commodity prices, which by and large is not good for us. And if the fisc remains under pressure, which I believe it will, I think the numbers will be close to 6%, maybe a tad higher than 6. It's going to put pressure on the currency.
Can we make a case for a bull market if rupee remains under pressure and fisc is high? Because these are two factors which always sort of restrict the upside for any equity market.
I think it will. As I say, we're not going to see runaway, this 3-4 year bull market story. I'm not personally convinced just yet, because for precisely the reasons, what's driving it is liquidity. Liquidity stays, but the fisc will be under pressure, rupee will be under pressure. But see, again, rupee is an interesting story. If the FIs decide, as I'm sure they will in January and February, when they've got fresh allocation of money to put in the emerging markets, as we did this year, you will see a gush of money into India. Rupee, in Q1 calendar next year will probably be better than it is today. But it'll be an early front-end loaded move in the market.
Do you think it's the overall pessimism which could fuel Indian markets? If I look at what domestic institutional investors have done so far for this year, they've got net outflows. They were net sellers to the tune of about 40,000 crore, which means that the average Indian investor is still shying away from Indian equities and is still investing in gold and real estate.
And, it takes, people have got burnt in equities at least a couple of times over the last half a dozen years or so. So memories can be slightly long.
Especially when you lose money.
Especially when you lose money. But I think like everything else, once people tend to jump on a sort of bull market bandwagon. And if you see that, I think, many of them come back. But I think there's been a lot of pressure on the mutual fund industry. There's been a lot of pressure on the insurance industry. So that whole garnering of deposits that drive markets for the domestics to be net buyers really hasn't been there, because if you look at AUMs of all the DIIs, they've been flat. And if they're not flat, it's because the markets are up generally. So there's no new cash coming in. So you've got to find a way to encourage investors to put in a larger part of their saving portfolio into equities, and frankly away from real estate and gold.
So let me rephrase or phrase my question rather carefully here. For a first-time buyer who is convinced and encouraged after this show that he wants to, take a bet in Indian equities, what should that first-timer buy? Bet on expensive consumer names or buy cyclicals now, where there is a strong scope of recovery?
See, I'm an old school guy, right? There's no way you can convince me that an individual investor with X amount of rupees, first-time buyer says, okay, maybe he's in his mid-20s and he's got his first job. There's no way people should be buying individual equities. You've got to be buying funds, because the fund manager community is an experienced community. That's all they do.
They've not made money in the last 4 years.
If they haven't made money, where's an individual investor going to make money? He might make money on one or two stocks, but on balance, I don't believe it's proof.
You have some lovely recommendations.
You have some great recommendations, but you've got to have diversity, because investing is about diversification and it's about compounding. If you forget those two, you actually can't make money. So you've got diversification in a fund, or if you want to do it individually, I can give you 20 names that you can buy and hold for the next 20 years and you do phenomenally well. But to put your money in 2 or 3 stocks and say, okay, this is the way I'm going to go, not the best idea in the world. So you've got to have diversification and you've got to let it compound. So the mentality of in and out every day, it's great for me, but that's not the way to build a portfolio.
There's an old maxim on Wall Street, which is that in markets, courses remain the same and horses, they change. So which are the new horses you're betting on?
Gosh, I would sort of start with sectors. Obviously, we were talking about a little while ago, media with all the digitization seems to be a place to be. We're still constructive on sort of financial services, banks.
Early days for media.
Early days for media. I think banks we generally remain constructive on. Sectors that we're probably less interested in continue to be real estate, infra, consumer discretionary we like. So it's, we like an M&M which has a sort of good governance story around it, names like that. So you can get 15 or 20 names that you can buy and hold for the next X number of years and actually do quite well. And there are many actually small NBFCs that have got a very good story going, and those are the ones to look at as well.
You used the word NBFC thrice already. What makes you so hot on NBFCs?
I think the overhang, one, it's an industry that's required in this country. The banking system, frankly, is not big enough to support it. If you've got the right sort of infrastructure architecture in place, the need for them is very, very high. I think the regulatory overhang, the worst of it at least, is behind us. All of them have spent the last 12, 18 months really putting a good credit system, IT, technology in place. And will continue to grow at least 3 times of GDP, which if you assume is 6 or 7%, you're growing at 20% a year. It's not a bad place to be.
That's Tarun Kataria, the investor speaking, or that's Tarun Kataria, the CEO of Religare Capital Markets speaking?
Bit of both.
So when do you think Indian markets will snap out of this range, this 4-year range?
Tough to say. If you look at China, China's been in this range for 5 years, and China is an economy 4 or 5 times as big as ours. I would have thought, listen, if liquidity continues to remain high, if you believe earnings are pretty close to their bottom, if not this quarter, certainly the next quarter, the global situation, and I believe it does look a little bit better, I think you can make a case for a nice move up. Now, you've got to separate the markets from the macro, and we can have a separate discussion on that. But I think the markets probably in 2013 do better.
But are markets running ahead of the time?
As they always do, right? I mean, that's what markets are. The pendulum swings excessive both ways. Markets probably fairly value to these levels, and if you get, as you correctly said, if the upgrades start, and if you believe there's a 15-20% change in earnings over the next 12 months, good time to be looking at it.
Do you think for Indian equities to rally, global commodities have to correct? Otherwise, there's no bull market for us.
It's not that strong because 5 or 6 things make for a move up in the market. But if you have massive moves up in commodity prices, which I don't see, because remember, a lot of the commodity price inflation that we saw in 06, 07 was driven by speculation. Yes. There was a China angle, great, 50%, 60% world consumption of X, Y, and Z. A lot of it was spec. And the spec was driven by cheap liquidity and leverage that providers to the traders was available. Yes. That gig is over, right? Everybody's very watchful of how much leverage they provide.
Risk management.
Exactly. So, can you see, as we think, it was 145 or 150 oil at the time was a straight spike up, silver the same thing. I don't think you see that because that speculative element is really not there anymore. So that last 20 or 30% won't happen. Now, can oil go up another $5-7 from here? The answer is yes. But it's not going to run away like we saw in 05 or 06.
So that's the big trigger, essentially.
Yeah.
Commodity prices, they come down, rate will come down, and that will benefit earnings.
And even if commodities don't come down, if we're able to take rates down by 100 bips, I think that'll be a huge plus.
What's your big call for 2013 then?
Gosh, the big call is, there's enough momentum that, maybe a GST comes through, maybe a land reform come through, maybe power sector reform, and actually that we haven't talked about that. If we can get 2 or 3 of those things in the frame, I think those are game changers. I mean, if you look at the 25 bills that they're going to put through in this winter session, for me, most of them don't mean anything in terms of moving the needle. But if you get these 2 or 3 things done, phenomenal, huge.
Are we abusing the word reform? Because none of the reforms are game-changing in nature. They are symbolic. They'll not add 1% to your GDP, or they'll not fix your macro. So why are markets so excited about reforms?
I totally agree with you, by the way. I think it's massively overplayed because they're talking about FDI and retail today. It's a sentiment changer. Is it going to, are you going to have flow of funds in the next 12 months that change the outlook for rupee? The answer is no. Is it going to materially change, the sort of farm to fork? Somebody used that expression a while ago. Yes. The answer is no. It's a 4 or 5 year thing.
Maybe more.
Maybe more, absolutely right. So what you need is near-term, domestic-related, and there are many of the senior sort of industrialists who've talked about GST being a material game changer. If you can get that going, it's terrific. Land reform, they've talked about in the last several months. Those are the things you need. Those are real reform measures. The 25 things, right, FDI and insurance from 26 to 49, great. Fine, we need to do it. I'm not taking away from that. But is it going to allow us, is it going to allow inflation to come down such that you can take rates down, such that you can go to 25, 27,000 in the sense? Those are the things to think about, and I think we're a ways from that.
On a scale of 1 to 10, what to your mind are the chances that in next 12 months we will be convincingly trading above 21,000, which was the previous high?
I would like to think it's a fair chance that we do that. I mean, that's 2,000 points from here, right? That's 10% from here. The answer is, I'd say it's better than 50-50 shot it happens.
That's a clear hedge.
70-30.
70-30. For markets now to stay above 21,000, which according to you is a 70% chance, apart from liquidity in earnings, what do you think will be the key trigger?
I think, as I say, if you can get these 2 or 3 reform measures, if we get the power situation sorted, you get a sense that supply side bottlenecks are being at least addressed. It takes time to take care of them. At least they're being addressed. Then people say, okay, inflationary expectations managed. Inflation perhaps comes down, 50, 100 basis points. That's a completely changed environment in my view, because we're very rate sensitive, like it or not. And yes, you can grow with 10% cost of money or 8% cost of money or whatever it is, if there's certainty around stuff. So if we get that certainty that the government's committed, they're pushing, they're not sort of stepping back as they've done the last few years, mood gets better.
You mentioned that staples are expensive. So are you making a case that staples as a group, that group could go through a price-wise correction or a time-wise correction?
Again, there's so much price-wise, a little bit of it trading at 30 times, maybe they go to 20 times, or 28 times, not 20 times, excuse me. But, it's got to be part of somebody's portfolio. There's just enough consumer spending going on that, these are all marginal things for us, right? As I say, if you're a long-term holder, you've got to be in that space.
When you say you like banks, I can crudely divide the banking space into 2. NBFCs we've discussed, I'm keeping that aside. Private and PSU. What are you hot on?
Right now, I think the bias is PSU because they've been beaten up quite aggressively. Some of the private sector banks, as we were discussing, are trading north of 3 times. Doesn't take away from, good stories, well-managed, risk management, etc. in place. But from a trading perspective, short-term, PSU banks have got beaten up. Does it make sense to buy and hold an SBI today? The answer is yes. That doesn't mean you get out of some of the other private sector banks to get into SBI, but on balance, a great place to be.
That's a big call. Focus on PSU banks. The risk-reward ratio is stacked up in favor of going long when it comes to the public space.
Correct.
I asked you this question last time when we interacted on this forum. I'm going to ask you that question again. If an investor walks up to you and his question is, I'm ready to take a 15% downside, maybe a 20% volatility, but give me some multi-bagger ideas. How would you address this query?
Gosh, that's a tough one. I mean, I would say if you go into our key calls, there are at least 5 or 6 names and see, if it's got to be a multi-bagger, it's got to be in the mid-cap space, right?
Again, high risk as well.
So anything that's $200 to $500 million, over the next 10 years can be a $2 billion company. And certainly not to go back to a bunch of NBFCs in that space, that could be quite interesting.
Could Religare be one?
Religare, actually, multi-bagger might be maybe tough because, again, we're very large. And if you look at as a mutual fund business or a money manager, we manage $15 billion. We've got a very large retail business. We've got an interesting life company. We've got our business, which is a regional investment bank. But it's large, and large businesses to grow at 15-20% a year is really quite hard. But in my opinion, and you might say I'm biased, are we an undervalued story? The answer is absolutely. And I think we need to do a better job getting the story out of how all this hangs together.
Good to have you, Nitina. Thank you for joining us, and good luck for the year 2013.
Thank you.
That's it on the show. Thank you for watching this edition of Market Makers. I'm Nikunj Dalmia signing off.